You're listening to the Financial Source podcast on YouTube.
Welcome to today's deep dive. We have got a massive stack of sources today spanning FX, bonds, and commodities.
It's a really heavy stack today. Yeah.
It really is. And our mission is to cut through all that heavy financial jargon to find out what is actually driving the global economy right now for you. Because if you think normal economic rules and central bank spreadsheets are running the show right now,
You are in for a serious surprise.
Exactly.
The overarching theme jumping out of all this material is that typical macroeconomic drivers are really just taking a back seat. Global geopolitics, specifically the intensifying events in the Middle East, are completely overshadowing traditional market fundamentals and dictating market sentiment right now.
So let's unpack the commodities board first, since oil feels like the linchpin of everything else happening. Both WTI and Brent crude are staging a really sharp rally.
And the sources make it clear this isn't a standard supply and demand story.
Right, not at all.
Yeah, it's not fueled by booming economic growth. It is driven purely by the fear of a protracted conflict. Traders are watching developments like the potential Houthi threats against strategic Saudi infrastructure.
And the recent direct action against Tel Aviv.
Yes, the immediate knee-jerk reaction across the market is just this massive fear of supply disruption.
So oil surges at the pump and on the screens. But the real story isn't just about the barrel itself. It's how that energy panic is bleeding directly into the bond market.
Right, because surging energy prices immediately spark major inflation fears. We're seeing U.S. Treasury yields climb, which isn't surprising given the unexpectedly strong hiring and services data we just saw out of the U.S.
With the latest ADP and ISM figures.
Exactly. Over in Europe, European bonds are retreating because elevated energy costs directly threaten to keep Eurozone inflation uncomfortably high. Even Japanese government bonds are dropping ahead of a 30-year auction.
Wow.
It's a global move to a higher yield environment, all tracing back to that oil fear.
You can clearly see investors reacting to that broader inflation and geopolitical threat when you look at traditional safe havens. Gold is advancing toward multi-month highs as people scramble for safety.
Right, they want that traditional security.
But I'm looking at copper, though, and it's barely moving compared to gold. If everyone is panicking, why isn't copper surging too?
Because copper isn't about fear, it's a barometer for industrial reality. China is the world's largest consumer of industrial metals, and they just set a relatively low GDP growth target.
So we have this stark tension in the markets right now.
We do. Risk-off dynamics and geopolitical fears are keeping gold elevated, while soft economic demand is putting a hard ceiling on copper.
Meanwhile, if you look at the currency boards, it is practically a ghost town. The U.S. dollar index is stuck in a really tight range.
Waiting for Friday's non-farm payrolls data.
Yep. And USD is completely flat, right around the 1.160 mark, basically idling while waiting for EU retail sales. And remarks from ECB officials like Christine Lagarde and Luis de Guindos. The pound is quietly hovering below 1.340. Nobody wants to make a move.
Currency traders are basically sitting on their hands right now. You could hear a pin drop on the trading floor. And what is really telling is that the Aussie and Kiwi dollars are largely unchanged.
Even with the Chinese yuan fixing.
Exactly. They're completely ignoring a firmer CNY fixing that just reached its strongest level in nearly 3 years. The entire Forex market is just paralyzed in a holding pattern.
So bringing this all together for you listening right now, what is the ultimate takeaway from all these moving parts?
Geopolitical headlines and energy prices are the true steering wheel for global inflation expectations and currency performance right now. Typical economic data is taking a backseat.
The dollar and traditional havens remain favored in the near term. But essentially, the entire global market is holding its breath to see what happens next.
That sums it up perfectly.
Which brings us to a final thought for you to mull over today. If geopolitical shocks continue to unilaterally dictate energy prices and override traditional economic data, how long until central banks completely lose their ability to control inflation through interest rates alone? Thanks for taking this deep dive with us.